Welcome to the Live Well podcast, where we explore how to navigate life's biggest changes, overcome challenges, and build a future that aligns with your values and your goals. Hi, I'm Matt Wilson, financial advisor, coach, and business owner of my practice here at Cornerstone Wealth Services in South Bend, Indiana, and I'm so glad that you're here. And a special thank you to TruthWork Media for hosting the Live Well podcast here in the beautiful Momentum Studios in South Bend, Indiana. This is an amazing place, and it's an amazing business hub here that they've created in downtown South Bend. TruthWork does an amazing job of helping people bring meaningful conversations to life. Hopefully, I would hope that you think that these conversations that we're providing you are meaningful to your life. And I'm excited to get into this next topic here. And we're going to kind of recap the series, but we've been doing a series on the 4 pillars of successful investing. Principles, not predictions. I remember I had a difficult situation with a client. The market was down very sharply, and he was emailing and writing a dissertation on all the things he was concerned about. I answered them and said, look, you're fine. There's the portfolio is your income in your portfolio is not market dependent. And I laid the case out and I said, we've got plenty of cash. We have plenty of income. You will never run out of money according to everything that I've ever done. There were some guarantees associated with it as well. And I remember saying a few phrases that we typically use in our industry, and maybe I'll share a couple of those today. But he says, I appreciate the platitudes, but I need real solutions. I said, platitudes? These are principles. They're not platitudes, and maybe they do get repeated, but they are still very, very powerful and very meaningful, and they're things to help you remember. So if you dismiss some of these as platitudes, then I guess I don't necessarily know how to help you, but I can tell you that they've saved people a lot of money, and they've saved people a lot of heartache by understanding these principles, and that's what I would call them. Again, principles, not predictions. So we've covered number 1, buy quality. We've talked about what that is. Be balanced, be diversified properly, not according to location, but according to the types of investments that you own, the places you get your income from. And today, the final pillar is have a long-term perspective. And this might be the most important pillar of them all. So now we have these 4 pillars holding up this gigantic, heavy marble table. If any one of these pillars are not present, not a very good situation, and that table is probably going to crash and break. None of these others really matter a whole lot unless you have this final pillar. So what does long-term really mean? Most people think of 5 years, maybe 10 years. But let me just give you the simple truth here. I think long-term means the rest of your life, whatever that is. It's not just retirement, though. It could be education, it could be major purchases, it could be income, it could be legacy, it could be lifestyle, any of these things. But it's planning really for every phase of your life. So your long-term investments really are just for the rest of your life, whatever that necessarily means. I'll never forget, early in my career, I knocked on this guy's door, and I introduced myself and said that I was a financial advisor. He looked at me and he said, son, I'm 94 years old. Investing? I don't even buy green bananas anymore. And I remember thinking, boy, that's perspective right there. To him, investing didn't make sense anymore. For him, it was about preservation. But for most people listening, I would say that you're probably somewhere in between, and investing still matters greatly in your life because your money needs to work for you. It needs to work for you for the rest of your life, whatever that is. If you can tell me that, my job becomes extremely easy, and I can really figure out exactly how we need to invest. But I can tell you overall, it really just means the rest of your life. Here's a stat that might surprise you. The economy has historically doubled roughly every 10 years. So people ask, well, how does the market keep going up over time? Well, it's because our economy is doubling every 10 years or so. But here's the key. The return doesn't really come smoothly. It comes through the ups and the downs. I've heard it said the market is, the stock market specifically, is like an escalator up and an elevator down. and you go down sharply, but then you ride this escalator up over time. It's a little slower, takes some time, you kind of look around a bit, but then bam, the market loves to use, or the media loves to use the word, oh, the market plunged today. That doesn't sound good at all, but it keeps you watching. Time is what turns volatility into growth. So let's talk about time versus timing. And that's a phrase that you've probably heard before. It's time in the market, not timing the market. And I would probably argue that it is about time in the market. Time in the market beats timing the market. Now, you can try to time things. I don't know anybody who's that good. I don't know anybody who is consistently doing that, because if they are, they're probably on an island, or they're probably not talking to you on TV. That's just the reality of it. Nobody is good enough to time these things. And if they tell you they are, then I would tell you that they probably have a bridge to sell you, or they probably have a timeshare to sell you. I mean, it's just unbelievable to think that people can get this right. Now, I think there are tides that shift. And the way I've explained this, and I said this in a previous episode, think of it like a baseball team. Your portfolio has these positions. You have 9 fielders. You have a defense for every batter. Every batter is different. You might have a batter who hits 17 foul balls, but they all go to the right. Or maybe you have a batter that's going to hit grounders consistently, and they usually go to left field. I mean, everybody it's old enough remembers a World Series where you saw everybody shift over to the right-hand side. And I think they've banned some of that recently to take away, because the stats were there. It showed you exactly what that batter's tendencies were. Well, I don't think the market's any different. I think the market is the same in the sense that, look, you can adjust your defense for what's coming at the present time. You know, rates don't go up 3 and 4% overnight. They don't go down 3 and 4% overnight. They take time to move, and there's kind of a direction. There are events that happen, and this is something that I want to make sure that people understand, especially right now if you're listening to this. And I don't know where we are with the conflict in the Middle East. There's been conflict for decades, but so you may come back and say, well, which one's he talking about? Well, I don't want to date the podcast necessarily, but I will tell you that there are things that happen, and it changes things and changes the complexion of the markets and the economy kind of quickly. Sometimes the markets will latch on to a particular news story, and they'll latch on to this news story for weeks. And then all of a sudden it gets off of that story and it gets back to the fundamentals and back to the earnings. And I've said this to my clients that there are 3 things that ultimately drive the stock market or drive the price of a stock. And that is, number 1, earnings, number 2, earnings, number 3, earnings. Now, I am being a little facetious on this, but I would tell you that at the end of the day, it matters whether they're making money, or it matters what their debt is. It matters what their income is. It matters how they spend money. It matters what their return on investment is. And I would tell you that eventually the market gets back to looking at those things and gets off of the news cycle. But inevitably, the market will attach to something until it doesn't. And it might be several weeks. It might be several months. But I can tell you that I've seen it over and over and over again, that there's a news story that happens. So let me just tell you that there's a statistic that is really quite shocking, and maybe I've said this already, but if you miss the 10 best days in the stock market over the last 20 years, your returns are cut in half. So that's 200,000 becomes 100, 500 becomes 250,000, a million becomes 500,000 because you missed 10 days. Now, I don't know when those 10 days are, but I can tell you they're usually right after or very near the worst days. And if you miss those days and you try to time it, you probably will regret that. I'm sure you've seen it before. The Dow is down 300, it's up 400, it's down 500, it's up 600. And if you're out of the market, you miss those up days. And that can be potentially devastating. The market rewards participation, not prediction. Again, the market rewards participation, not prediction. So why do people struggle? Let's talk about why this is so hard for a little bit here. And I would say that, and everybody is aware of all the money that's being spent on the weight loss drugs that are out there, and some of them can be very beneficial. I'm not going to downplay this. I'm just going to say that investing is a lot like losing weight. It is a very, very simple formula, but it is so incredibly difficult to do. And we spend so much money on it. We spend so much time on it. And yet the formula is never going to change. Now, is it harder for some than others? Yes. Are there other challenges? Yes. I'm not going to get into that necessarily, but I will tell you, it's very hard to do. And I'm going to acknowledge that. And the reason really is this: when things are good, people feel confident. They invest more. They take more risk. And when things are bad, they panic. They pull back. They go to cash. Here's something that might surprise you. Right now, in 2026, there's roughly $8 trillion in cash, in checking and savings. In my understanding, there's another $8 trillion in money markets. That's trillions with a T, waiting, trying to time the market. And what happens? The market drops, then the market bounces up again, and people end up missing it. Or money rushes in because they know that they've already missed out on the gains and they want to try to recoup some of that. So they're trying to time things, but I understand, there's uncertainty out there, and cash is not necessarily wrong, but I had a guy one time, he had several $100,000 in cash. It was making zero at the time. And I said, why do you have so much cash? And he just says, well, I might need it. I said, are you going to buy a boat? I mean, what are we going to do? You can get at least a little bit of interest. And this was at the time when there was nothing on cash. And anyway, long and short of it is, cash isn't necessarily wrong. But again, money is a tool. Use it or it's going to use you. And then again, some people find comfort and they find identity in having a certain amount of money. There's other people that they find comfort and they find identity in using that money. So how do we make the money work for you for whatever goal that you might have? So some people, we take their funds and we pay them an income from those funds, but at the same time, maybe they're going to leave something for somebody or something. And I've talked about legacy in the past. Maybe you're going to leave a pile for somebody or something. Maybe you're going to give somebody a chance and you're not going to leave anything. Maybe that's not your goal. And maybe you're not going to leave anything and you're going to spend it all. And you might not have a whole lot to give to whatever cause or person or whatever it is that you support or love. But you gave them a chance. So I think the third legacy is just don't leave a mess. So if we can figure out how to not leave a mess and maybe do one of the first two, then I think that would be helpful for everybody in your life, and including yourself. Another mistake I see all the time is people following the crowd. They listen to their neighbor, they listen to the media, they listen to what the latest investment is, whatever the hot investment is at the time. Gold comes to mind, precious metals. I keep hearing about different things at different times in my career, but I can tell you by the time that you hear about it, it's usually already happened, okay? You've probably missed out on that opportunity. In other words, if everyone is talking about it, you are probably late. So I can't say that truthfully about everything, but it's pretty good principle to live by. In the media, their job is not to help you invest, okay? Their job is to keep you watching. So that's why negative news does better than positive news, because people don't want the positive news. They want the negative news. They want to get riled up. They want a mass formation syndrome on that particular issue, and people want to feel like they matter or whatever it is. But at the end of the day, good news doesn't sell, bad news does. Their job is to keep you watching. Just be careful when you start getting mixed up with some of these stories or doomsdayers or things like that. It's probably not as bad, and maybe it's not as good as what people think, but it's probably not as bad as what people think either. Negative news gets significantly more engagement than positive news. Fear sells. So think about a soldier that's going into battle, okay? He's got armor, he's got weapons, he's got food, he's got gear, but if he doesn't have shoelaces, he's in trouble. It doesn't matter how good your equipment is, it doesn't matter how good your vest is, your helmet. It doesn't matter if you can't function. And, whether it's bootstraps or shoelaces or whatever, if your shoes are flopping around or if you don't have shoes at all, I can guarantee he's not going to be as effective. I may be wrong on that, but think of long-term perspective as the shoelace of investing. An often taken for granted thing, something that you don't really think about very much, but if you don't have it, you're probably not going to be as effective. So you can have great investments. You can have perfect diversification. You can have strong balance in your portfolio, but without long-term discipline, none of it's going to work. So this is where planning comes in, okay? So you may have short-term needs, you may have mid-term goals, you might have longer-term investments. Think of 529 plans. Well, that might be the next 5 to 15 years. Major purchases. You might need a new vehicle in the next 5 years. Retirement income, maybe that's 10 years, maybe that's 20 years. It might be longer. It might be right around the corner for you. Sometimes we take risk off the table. And sometimes we might even use guaranteed income strategies, or what we might call mailbox money, right? So that your basics are covered so you can go live your life without worrying about whether you're going to make it every day. So think of it like this. If you have a rental property and you are going to own the rental property, and do you care what the price of the property is, or do you care about the rent check? Well, that depends, Matt. Depends if I'm going to need the money. Exactly. So, if you need the money, then you may not want to deal with the potential real estate movement or the price of real estate. Think of the 2008 crisis. Everything went down very quickly, and it took years to recover. I'm not saying we're going to face that again, but at the end of the day, if people had a bunch of rentals and they had rental contracts and they were getting that income, did they really care necessarily if the values went down at the time? No, they cared if they continued to get the rent check, and that was extremely important. So in that vein, let's shift perspective just for a moment. So most people today are participants in investing. They're not owners. So you put your money into a 401k, you have a select list of investments that you can own, and you hope it works. But here's the truth. The 401k isn't going to pay you a rental income. You're going to participate in it. But what if instead that you could actually be an owner, and if you thought like an owner? So what if you owned assets that paid you income, investments that paid you dividends, strategies that supported your life? So this is where the IRA comes in. And, an IRA is an individual retirement account, and it was created back in the 70s to give individuals a little bit more control over their investments and their retirement savings. So I just want to make this point that unlike a 401k, you often have more investment choices, you have more flexibility, and you have more control over the income strategies that you have. You have more ability to design around your life. So you diversify the types of income that you might have as well. And it's all in the vein of, look, we want your money to be working for you while you live your life. And that might mean income-producing assets, structured income, or again, guaranteed income in some cases. So your life isn't dictated by the market. Your life is supported by your plan. So if you're listening to this and thinking, I don't know if my plan is built like that, well, that's exactly what we do at Cornerstone Wealth Services. My process is very simple. We discover, we design, and then we deploy the pieces and the necessary strategies to help you live a life that's aligned with your goals and your values. We ask what matters to you most. Number one, what are your goals? Number two, and things like what worries you, or it would be nice if what. And I can't tell you how many people say, boy, Matt, we've never actually talked about this before. So if you like a second set of eyes, just visit mattwilsonfinancial.com and reach out to me there. Let's build a plan that's going to work for you. So let's bring this all together. Number one, to be a successful investor, you need to own quality. Number two, you need to stay balanced. Number three, you need to diversify properly. And number four, you need to think long term. It's principles, not predictions, that build wealth. And again, coming up next, we're going to dive into the 7 biggest financial mistakes I've seen people make, real mistakes, real consequences, and how avoiding them can completely change your financial future. Until next time, money's a tool. Use it wisely so you can build a life that allows you to truly live well.